Okay, welcome everyone. I think we'll get started with my introduction, and then as people dial in, it'll be by the time Marcellus get a chance to speak. So welcome everyone to today's Emerging Market Strategy Update webinar, which is going to focus on India. I'm Eric Anderson, and I'm the head of Emerging Market Investments at Milltrust International, which is a London and Singapore-based asset manager with a core focus on delivering global emerging markets investment solutions to investors. For today, after a brief introduction from me, we're going to hear from the Indian investment manager, Marcellus Investment Managers. Marcellus was founded in 2018. The founders have worked together for more than 15 years now, which has helped shape a very successful investment philosophy and strategy for the Indian markets. The teams seek to invest in heavily moated companies that can generate healthy earnings growth for long periods of time. They've developed a proprietary, well-defined framework to identify these companies, which they will talk about today. Today, we're going to hear from some of the members of the investment team, including the CIO, Saurabh, and the portfolio manager, Rakshit. Everyone on the team has been a top-ranked analyst in India for many years. This is also the team that came out of Ambit Capital, which had been one of the most successful and highly rated research teams in India. The current Indian strategy that Marcellus runs on the platform has already won awards, including one of India's top-performing equity products in 2018 and 2019. After the short presentation by Marcellus, we'll have the opportunity to open up to questions from the listeners. To ask a question, simply type it in the Q&A section in your Zoom panel. You can ask them at any time during the presentation, and we'll get to it at the end. We're going to try to keep this to 30 minutes, so if we don't get to answer all your questions, then we'll follow up directly afterwards. And before handing it off to Marcellus, I just want to give everyone a quick overview of how Milltrust fits in. Our approach at Milltrust is to identify leading locally based investment managers in each of the key countries and regions across the emerging markets who are specialists in putting together high conviction portfolios of high quality companies. Each specialist team manages their regional portfolio within a sub-fund on the Milltrust Emerging Markets platform. These sub-funds form the basis of our global EM strategy. Investors can either invest directly into the sub-funds, such as the Milltrust Marcellus India Fund, and build their own exposure to these countries and regions, or invest through the Milltrust Global Emerging Markets Fund, which allocates across the sub-funds on the platform. So that's enough from me. I'm going to hand it over now to Marcellus. Over to you, gentlemen.
Thank you very much, Eric, and thanks for inviting us to join this session with Milltrust's clients. So my name is Saurabh Mukherjee. I'm the CIO. I'm joined today by Rakshit and Pramod. We've been working together for 17 years now. And as Eric was speaking, I remember that we joined forces actually in London in 2003, where I co-founded a company called Clear Capital, which used to do small cap equity research in the UK. We migrated to India in 2008, and we spent 10 years understanding India before we started managing money. What we do is actually very straightforward. Rakshit, if you could move to the next slide. What we do is three things. We look for companies with 10 to 15-year track records of clean accounting. There are roughly 80 companies in India that fit that bill, clean, believable accounts. Amongst them, we look for companies with selling day-to-day essential products and services, products that India's 1.4 billion people need to stay alive. Amongst them, we look for companies selling essential products with good capital allocation. And most importantly, the third step of our work is we look for companies basically that are monopolists, right? We call it barriers to entry, but for all practical purposes, we invest in Indian companies which operate by and large unchallenged in India. And that is the sort of the tricky part of figuring out, because obviously these companies don't come in the public domain and tell the whole world that they're unchallenged. It's our job to figure that out. So clean companies selling essential products, high barriers to entry. Just to give you a sense of how broad the spectrum of these companies is. At the larger end of our portfolio would be HDFC Bank with $100 billion market cap. Somewhere in the middle would be Asian Paints with say $22-23 billion market cap. Then you'll have a company like Relaxo, which sells India's largest footwear manufacturer with $3 billion market cap. Right? All of these companies are essentially similar, clean, well-run, quasi-monopolistic operations. The typical return on capital employed of an investee company would be 30 to 40%. 2/3 of the free cash flow would be reinvested back in the business to generate steady earnings growth in the vicinity of 20%. So I'll take you through the first couple of steps, and then I'll hand over to Rakshit for step number 3, the monopoly step. Right. So the first thing we did when we migrated here was we spent a couple of years actually meeting some of India's most prominent companies and understanding how they cook their books. Right. And this is actually if you ask me, the most essential function of an Indian analyst or an Indian fund manager. Accounting quality in India is highly uneven. If you look at the Nifty 50, for instance, the benchmark index in the country, or take MSCI India, whichever index you prefer, you will see in that 2/3 of the constituents of MSCI India deliver no free cash flow, right? If you look at the last 10 years annual reports of 2/3 of the MSCI India companies, there'll be no free cash flow. But if you look at the lives of the people who own these companies, they'll be living it up in Mumbai or Singapore or Dubai or wherever, right? And that's the anomaly we spotted very early on. And we built, in the first 2 years, we built this forensic accounting framework that you see on the screen on your left, right? These are 10 forensic metrics. Every year in December, the 12 forensic accountants who work for Marcellus apply this framework to the 500 largest companies in the country. And our job is to use a rational quantitative framework to figure out which company is cooking its books to what extent. So for example, just to take one ratio number 7, if auditors' fees are consistently rising faster than revenues, if over say 6-7 years, auditors' fees are rising faster than revenues, you know that there is a red flag there. The auditors basically being incentivized to do naughty things. And some of you won't be surprised to know some of India's most prominent companies do this. This is a big part of our work to make sure that the investor universe you're focusing on, the accounts are believable, which is unfortunately not the case for the vast majority of Indian companies. So this layer of work, the forensic work, gives us a superset of around 100 companies to focus on, right? And that's when we then go on to the capital allocation piece. Rakshit, let's go forward one slide. It took us around 5-6 years to figure out that there is a relatively straightforward way to think about capital allocation in India. And the method we created around 2015, 2016, published in our book Unusual Billionaires, which went on to become an Amazon #1 bestseller. In Unusual Billionaires, we explained that the simplest way to understand good capital allocation in India is to use two straightforward metrics. Return on capital should be consistently above cost of capital, and like so for 10 to 15 years. ROC above cost of capital for 10 to 15 years. Revenue growth should be consistently double digit for 10 to 15 years. Now, for a moment, assume that we're not applying any intelligence at all. We're just applying the simple filter, double digit revenue growth, ROC above cost of capital for 10, 15 years. If we did that, the portfolio that we would build would have consistent returns, rupee returns in the vicinity of 20 to 30% and 8 to 12% outperformance vis-a-vis the index. Furthermore, such a simple portfolio built using two financial filters would be giving you volatility commensurate to a Government of India bond. A 10-year Government of India bond would have a volatility similar to this portfolio, right? This is the crux of the book that we published 5 years ago, which actually paved the way for us to become fund managers. So clean accounts, good capital allocation. If you apply the capital allocation filter, our universe within which we have to conduct research gets narrowed down to 25 to 30 stocks. And now step three of what we do is amongst that universe of 25 to 30 stocks, we look for monopolies. We look for companies which effectively have no competition. And to talk you through that, I'll hand over to our portfolio manager, Rakshit.
Sure. Thanks, Saurabh. Hello, everyone. So as Saurabh mentioned previously, we call this step high barriers to entry, but it's actually a search for monopolistic control on the whole industry. And in this regard, when it comes to monopolistic control, India is quite special, we realize, amongst larger economies globally, in the sense that India has several industries with one or two companies controlling 70, 80, 90% of the profit pie of the entire industry, and hence being utterly dominant at a profit level, if not at a revenue level as well, right? That's not it. The unique part about Indian dominance of certain sectors is that some of these dominant companies are also able to deliver returns on capital employed substantially above cost of capital. So just to take simple examples, if cost of capital for, let's say, a firm like an Asian Paints or a Britannia or a Nestle is say 12, 13%, then the return on capital employed of these companies has been at 30, 40, 50, 60%, substantially above the cost of capital, and the gap is effectively free cash flow that the business throws out. What is unique is that this gap theoretically should always attract competition, which tries to narrow the gap down to as low as possible. But in India, some of these dominant firms have been able to sustain this gap for very long periods of time in a very wide manner, right? So 50% return on capital versus 12-13% cost of capital sustained for 3, 4, 5 decades is something that we don't find elsewhere in other large economies, but it is prevalent for, say, a dozen or 2 dozen companies in India. Now, what that does is if you've got companies which are generating substantial free cash flow, or predominantly the entire free cash flow of the industry into the hands of 1 or 2 companies, and if these companies can also reinvest that capital back onto the balance sheet to grow the business in future whilst retaining their higher levels of return on capital, then effectively the whole industry, it ends up getting monopolized into the hands of those 1 or 2 companies in a manner which is shown in this chart on the left. So what this chart shows you is the top 20 corporate profit generators, right? Top 20 companies generating profits in India. They contributed to only about 15 to 20% of overall corporate India's profitability till a couple of decades ago, right? So till 1995, 2000, 15 to 20% of overall corporate profitability of the country was coming from top 20 corporates by profits. That number, that contribution from 15-20% 2 decades ago, today has risen to more than 70%. And pretty evenly that rise has come over the last 2 decades because, as we explained, is the monopolization of certain industries that is being played out here, right? 2 weeks back, we actually published an updated analysis of this subject where we showed that in FY20, financial year 2020, as much as 90% of corporate India's profitability was contributed through the profits of the top 20 corporates only, right? So top 20 contribute to 90%. So that's the degree of monopolization that is happening in India. What we want to figure out is if there are elements of a DNA underlying a company's ability to sustain higher degrees of returns on capital and revenue growth consistently in the past. We want to identify that, get convinced about its sustenance into the future, and then invest into these businesses. So if you look at the outcome of this approach, this slide 7 shows you 2 tables which have time periods from 1 year to 3 years to 5 years for the 13 stocks that Marcellus has in their portfolio, right? For these 13 stocks, the table on the right shows you profit after tax progression over 1, 3, and 5 years, and table on the left shows you share price progression over the same 3 time horizons, right? What is quite remarkable is if you look at the bottom 2 rows. So the bottommost row is something called Nifty 50, which is the benchmark index for the top 50 companies listed in India. And the second last row is the overall weighted average metric for our portfolio, for Marcellus's portfolio, right? Last 5 years in particular, if you look at financial year 2015 to 20, which is the extreme right column of the table on the right, last 5 years have been very disruptive, right? There have been events, some of you might be aware of demonetization. There was a GST, a new tax regime which came in 2017. More recently, there was COVID-related disruption, and the entire financial sector has been in a bit of a stress in the interim as well. Despite all of these disruptive and evolutionary changes that have taken place in the Indian economy, whilst Nifty 50, the benchmark index, has delivered 0 profit compounding, our overall weighted average at a portfolio level has been a 19-20% profit compounding, right? The 19-20% has come when the economy in general has not seen profits go up, but only for the 13 stocks that we've got, we've seen the profits compound at a very healthy rate, right? Now, the main reason why this happens is these companies, they tend to benefit out of a stressful external environment by taking initiatives which widen the gap against their competitors massively during times of stress. Right, because during times of euphoria, it's very difficult for a great company to show significant outperformance versus the rest, because everybody is playing in a euphoric environment. It's during times of stress that the greatness of a real sort of consistent compounder, it shows out very clearly, and that's what this table has shown. And share price obviously is going to track fundamentals on the longer term, which is what has happened over the last 5 years, both for Nifty 50 as well as for our portfolio companies. Now, what is also quite interesting is this doesn't show you the post-COVID period, so the last six to 9 months in particular. In subsequent slides, we can show you granular data on that if needed. But even over the last 6 to 9 month period post-COVID, these corporates have kept compounding their profitability by more than 20% on an annualized basis, and that's what makes the portfolio quite remarkable in the low risk, high return aspect of the fundamental compounding and hence share prices. Now, coming to one example of how these companies have done what I just discussed over the last 5 years, they've actually also done the same over the last 5 decades. Right? If you look at this firm, this is actually the largest allocation in Marcellus's consistent compounders portfolio, Asian Paints. It's India's largest paint company, about $25 billion in market cap, as Saurabh mentioned. And the chart on the top right shows you last 7 decades of fundamental track record of Asian Paints, where vertical bars are decadal revenue CAGRs and the 2 lines are profitability metrics. Right? The dotted one is return on capital employed, and the solid line is just profit margin. Right? The most remarkable thing about this chart is over the last 7 decades, no matter which era of the Indian economy or of paint industry's competitive intensity, or even promoters, the management team, the professionals working at Asian Paints, their changes through generations, through succession, etc. None of those factors have brought any volatility to the fundamental way of compounding for Asian Paints, right? Last 7 decades, revenue compounding has been at around 20% CAGR. Return on capital employed has never gone below around 25%. For the last 3 decades, it's been only going up, and profit margins for the last 5 decades have been going up. That's the consistency regardless of disruptions and evolutions in the external environment that Asian Paints has delivered upon. Now, how have they delivered that? So very quickly, just to use this as a case study, what these companies do, and Asian Paints did a similar thing, is they identify the most challenging aspect of their industry, right? And then rather than trying to resolve the challenging aspect of their industry in a simple, straightforward manner, they actually first intensify the challenge themselves by changing the construct of the industry to make it more difficult to operate in for everybody, including themselves. And then these firms, they come out with a solution to the challenge in a way that can't be replicated easily by competitors, right? And if you can keep doing this decade after decade and keep coming out with ways of overcoming the challenge, which can't be overcome easily by others in a similar manner, then you can have what Asian Paints delivered as a historical track record. Now, what the challenge of the paint industry is that the product is very voluminous in nature, right? It's about 10 times more voluminous than a typical FMCG or staples or consumer good product, right? The simple solution around managing voluminous nature of a product in a B2C manner of distribution, the simple solution to address voluminous nature of distribution is come out with several channel partner layers, right? So you can have distributors, wholesalers, stockists, super stockists, various channel partners from the manufacturer to the retailer on the high street can take the voluminous product for a few days in sequence, and the manufacturer can manage distribution of a voluminous product across the length and breadth of a country as big as India, as diverse as India, right? What Asian Paints did was they intensified the challenge rather than resolving it in a simple, straightforward manner by appointing distributors. How did they intensify it? They actually removed all channel partner layers. They said, let's just throw out all layers so that the manufacturer has to sell directly to the paint dealer who sits on the high street and interacts with the end customer. Right? There will be no channel partner layers in between, which obviously makes it even more difficult to reach the length and breadth of this country in a voluminous product with sort of more than 6,000 SKUs within the product portfolio of a firm like Asian Paints. In addition to that, what they also did was they compressed the margin of the channel down to about 1/10 of what it typically is for various consumer goods companies, right? So whether it be a staples or apparel or footwear company, typical margin available in the channel is around 20 to 30%. In Asian Paints' case, they've compressed that margin down to only about 3%, right? Paint dealer is the only channel partner left in the entire supply chain of Asian Paints between the customer and the manufacturer, and that channel partner makes only 3% margin, right? Now, when you combine the voluminous nature of the product, which obviously makes inventory storage a very big challenge for the paint dealer on the high street, and combine that with only a 3% margin compared to a 10 times higher margin that the neighborhood dealer of staples or apparel or footwear would be getting, what you're left with is that the paint dealer can survive in this sort of a challenging construct only if the inventory turns are phenomenally high and they deliver the cash flow for the paint dealer, right? Because the paint dealer neither gets a fat margin, nor does he get a lot of inventory to be stored at one point of time in his shop. So he wants inventory turns to be very, very quick, very fast. If I were to very quickly summarize it, compared to a convenience store, for a same degree of return on capital to be generated by a paint dealer, the paint dealer's inventory turns have to be 40 times faster than that of a convenience store. Now, 40 times faster means that a typical convenience store in India gets supplies from a Unilever or a Britannia or a Nestle once in 10 days, and the neighborhood paint dealer needs supplies from Asian Paints 4 times in a single day. That's 40 times faster inventory turns that is needed for a paint dealer to make the same amount of money that a convenience store next to him makes because of the compressed margin and 10 times more voluminous nature of the product, right? Now, delivering 4 times in a single day across 6,000 SKUs to 600 or more cities and 70,000 dealers directly is the supply chain challenge that this whole construct throws up, right? Only Asian Paints can resolve this, others can't. As a result, Asian Paints has delivered this chart on the top right, when others have sort of delivered the usual volatility in their fundamentals. How does Asian Paints do it? For the last 5 decades, Asian Paints has been the most proactive investor in technology across most corporates that we've come across in India, to the extent that which SKU has sold at what point of time in the past, in which nook and corner of the country, Asian Paints has captured that data and used it to forecast demand for their own products with an accuracy that gives a guarantee to the paint dealer about 97% or higher product availability within 3 hours on the entire spectrum of product portfolio that the dealer might choose from, right? More than 97% of products available at the doorstep within 3 hours is a guarantee provided by Asian Paints. Otherwise, they give extra incentives for lack of meeting this target. No other company can do it even with 1/3 or 1/4 the pace of inventory turns that Asian Paints provides to the dealer. As a result, the dealer only stocks Asian Paints' products. The painter who has to apply paint on the walls with a labor workforce that cannot sit idle because of unavailability of stock at the nearest dealer's level, the painter pushes only the shade cards of Asian Paints, and the customer who's got no idea about what is a good or bad quality paint relies only on the contractor or the painter for advice on which paint should be put on the walls. The customer chooses whatever the painter pushes, which in turn is only the fastest inventory turn with the dealer, right? Now, this makes 2 things totally redundant. Quality of the paint doesn't matter in India, right? Dulux Velvet Touch is a product of AkzoNobel, one of the MNCs. That is the best quality paint that we have come across in our interaction with painters that they say is the best quality paint, but doesn't sell. Why? Because it doesn't provide inventory turns to the dealer, right? So product quality doesn't matter as much as inventory turns matter. Secondly, even the approach of burning some cash to dislodge an incumbent dominant player doesn't work in India. So Sherwin-Williams, world's largest paint company, entered India in 2006, and they decided to give 5 times higher channel margin, which is the paint dealer's margin, 15% versus 3% from Asian Paints, right? 5 times higher margin to the channel. In addition to that, they spent $1 billion setting up factories and depots and the entire supply chain infrastructure. After 5 years of doing this, they got to only about 90 crores of revenue. 90 crores is hardly $15 million of revenue in 5 years. And they left this country after selling their business to another paint company. That's how difficult it is. Why? Because the paint dealer says that, look, we are aware what Asian Paints does with a 3% margin and makes us money via 4 times a day inventory turns is a sustainable approach. What you are doing by giving us 5 times more margin.
Some of the attendees are saying they want to look at some other stocks. So let's just quickly do Bajaj Finance and then we'll wrap up. I think Eric said they want to wrap up by half an hour. So folks, just as Asian Paints is actually a tech company masquerading as a paint company, Bajaj Finance, which is now India's second largest non-bank lender, is also a tech company masquerading as a lender. So Asian Paints, the secret is 50 years ago, they invested in India's first supercomputer. They have the largest data bank of paint demand at a very granular level, as Rakshit said. Bajaj Finance did the same to the lending industry 12 years ago. Actually, my neighbor, the man who used to live his father lives now in the flat behind me, and Rajiv Jain, the man quoted in this slide, he moved to run Bajaj Finance 12 years back. And what Rajiv and the Bajaj Finance promoters realized is there is a way to build an Indian lender in a completely different construct to what has hitherto been done, which is to use big data and data analytics for underwriting. So the first 3-4 years, they spent collecting more data on the most affluent 100 million Indians than any other lender had done before or has done since, right? There is a variety of reasons why data privacy rules in India are different from what you have in Europe and America, and it allows any corporate, including Marcellus, if you are so interested, to go and collect tons of data from people's mobile phones. Bajaj did that, and they used that data very cleverly. They used that data to identify whole classes of borrowers which other lenders thought were high risk, and Bajaj Finance realized were low risk, because Bajaj Finance could see from the big data that these borrowers actually have very stable cash flow patterns. The first such case study they picked up was doctors and dentists. There's around 1 million doctors and dentists in our country, and Bajaj Finance realized that these are very stable customers, for obvious reasons. The CEO, Rajiv Jain, gave the order to give the doctors and dentists the best rates possible. By 2014, Bajaj Finance has built the largest doctor-dentist loan book in the country. And then they proceeded to put the next barrier to entry. Big data was the first barrier to entry. The next barrier to entry was they stratified the doctor-dentist book into 600 risk buckets. Basis, is the doctor from a top 10 medical school or a bottom 10? Is he a cosmetic surgeon? Is he an oncologist? Is her clinic in a prime part of Mumbai, or is her clinic in the boondocks? And if you were an oncologist in a prime part of Mumbai, you'd get the best rate possible. If you were a cosmetic surgeon from a third tier medical school in the boondocks, you would get a much higher rate. And as soon as they did this, they stratified the customer base. The barrier to entry was thus established. Because now, if a new lender enters, he doesn't have this privileged data, right? He does not know who's the prime customer, who's the subprime. He offers an average rate. At that average rate, the subprime customer gets sucked to the lender. The prime customer stays with Bajaj. Once they perfected this on doctors and dentists, then they rolled it out for chartered accountants, lawyers, architects. And today they have the largest book of white-collar, self-employed professionals, right? There are several other stories of them using big data to build very powerful monopolies. Now, what is the result of this? The result of this is a 25% ROE NBFC in a country where other NBFCs struggle to cross 15% ROE. Not only is this higher ROE, The debt equity ratio here is 5 times compared to the industry average of 10 times. And this is asset liability reverse matched. Other lenders borrow short-term money, lend long-term. Bajaj Finance borrows 4-year money, lends short-term, right? So they're de-risking on the ALM side. They're de-risking on debt equity. They're giving us the lowest non-performing asset ratios in the country, the highest ROEs, and the highest compounding. And this aspect of India is why we migrated to the country. You're able to get low risk compounding consistently from around 20-25 companies, 20% compounding at a stable rate, low standard deviation, therefore superior Sharpe ratios. And we reckon amongst the countries that we've lived and worked in, this is a unique proposition. Large country dominating monopolies with very powerful barriers to entry built around technology and around regulation. We'll be honest, it's regulation and technology in even measures, and the inability of the market to factor that into fair values gives us the arbitrage, which allows us to consistently chug out 20% returns for our clients. So clean companies, good capital allocation, monopolistic barriers to entry becomes the recipe. There's very little turnover in our portfolio. In a given year, out of our 13 stocks, we sell one and we buy one. We don't really lose that much sleep about quarter to quarter earnings growth or GDP movements or the government's pronouncements on various subjects. Our goal is to focus on those 3 aspects: accounting, capital allocation, barriers to entry, and that is the consistent compounders portfolio. So we'll stop there, Eric, in case you or your clients have any questions.
Yeah, so I think you've addressed, thank you for that. Very interesting. And I think you've addressed a number of these questions already as you've seen them come through. The one question I just want to ask, and it's come through a couple of times, is on valuation. As an allocator to Indian markets, we always see the relative valuation being quite expensive in India. Is it a timing play? Do you have to think about that? And obviously looking at your track record and the decades of outperformance there, it almost seems a ridiculous idea to people to time the markets. But perhaps you can give us a sense of valuations today and your thoughts around timing Indian markets. That would be helpful.
Rakshit, do you want to take Eric's clients to this valuation conundrum?
Yeah, I'll do that. So to put it very simply, there are two factors, as this slide shows, which contribute to the share price movement, right? One of the two is a compounding factor and the other one is not. And again, just further putting it in a simple way, out of the two compounding factors, right? If you've got a very weak rate of compounding on the earnings front, right, then timing the PE multiple becomes very important. Right? Why? Because the PE multiple might oscillate between, say, doubling, halving across a decade. And if you've got a long-term time horizon of, say, 5 or 10 years, then that doubling, halving across a decade is a +7, -7% contribution to the CAGR on the PE multiple front. Or if it's a 5-year, then it's more like a 12-13% contribution to the CAGR on the PE multiple front, right? Without earnings compounding, you're left with only PE multiple to play around with. And even if you played with the PE multiple in the best possible manner, right, you won't be satisfied with the outcome of share price compounding of high single digits. And there are many companies, as Saurabh mentioned, many companies in India where this problem exists.
By the way, this is the Indian benchmark for you. What Rakshit is showing you, we called it A's for airlines because our telecom companies and our airlines and our power and infrastructure companies are like this. But the Indian index is exactly like this. 0 earnings compounding in a decade, doubling of PE, thus at the index level, the Nifty has given 7-8%, but without any earnings growth for 10 years.
Now, a little bit more, I would say, matured way of investing, a smarter way of investing is hunt for companies which do compound earnings at least at the rate of India's nominal GDP growth, which is whatever 10-11%. And there are good quality companies like, say, Unilever in India or the largest four-wheeler manufacturer, Maruti, etc., which compound at, say, 12-13%. Now, if your earnings compounding is 12-13%, then obviously, as Eric put it, you can't be all right with PE multiple compression. And in fact, you have to capture PE multiple expansion in order for the outcome of the share price compounding to be closer to, say, 20% or higher. This is in rupee terms. This is all in rupee terms. So you can shave off dollar depreciation, rupee depreciation against the dollar. at a rate of say 4-5% annually. But in rupee terms, if you want to get to say 20% compounding of the share price, you have to get a combination of PE expansion along with a 12-13% earnings compounding. Whereas a unique set of companies, right, Bajaj Finance, Asian Paints equivalent, if you can convince yourself about the sustenance of their earnings compounding in the band of say 20-25% for a time period as long as 5-10 years, right, which is actually the most difficult part to get convinced about. But provided you can get convinced about the sustenance at that rate for a time period that long, then PE multiple doubling, halving becomes more or less a redundant exercise in terms of the nature of the outcome, right? And that's what our approach is. We are buying into companies which, as we showed in one other slide, even in a disruptive environment like the last 5 years, we've delivered 20% earnings growth. Post-COVID, the earnings growth has actually accelerated more towards 30%. And if we can compound earnings at say 20-25%, then PE multiple doubling or halving is a sort of a
link this point Rakshit is making to the point which is in the Q&A box about transparency. The 90% of the Indian stock market is in that category A's for airlines, right? And you can imagine, right? Airlines, telecoms, power infrastructure, metals, mining, right? These are sectors where the government's hand is very heavy. Regulatory intervention is very heavy. These are sectors where free cash flow is almost impossible to generate, and regulatory intervention is heavy. And I'm sure, I presume you guys have invested across the world. That is a classic recipe for the regulator and the owner of the company, the promoter and the regulator, working hand in glove to make sure that those two are looked after, and you and I are left holding the can, right? And this is but obvious, right? That if you have sectors where, for example, to set up a hotel in Mumbai, you need 60 regulatory clearances, which is why there's no hotel company in India in history which has generated free cash flow, because once you're done getting those 60 clearances, there is no free cash flow left. Similarly, with somebody's asking about green infrastructure, power plants, metals, mining, real estate, so on and so forth, right? So the bulk of the Indian stock market cap is allocated to the 0% EPS compounders with no cash flow, and where, yes, governance is an issue, but they've already got the system sort of somewhat captured, right? And it becomes a self-fulfilling thing. If I know as a promoter, as an owner of a company, I don't have competitive advantages, barring capturing the regulator, then I'm going to do that. I'm just going to capture the regulator and make sure minority shareholders are left in the lurch. If on the other hand, I'm in category C, which is a mere 1% of the Indian market, if I'm in category C, I can see I have built a 40% ROCE machine, which can compound at 20%. Then I will build my wealth by compounding this earnings machine. Why will I go and spend time defrauding minority shareholders? So it becomes a self-fulfilling thing. Promoters self-select. Some promoters self-select to join category A. Others self-select to become the elite monopolists who are in category C. And in between these two extremities is around 8-9% of the market. MNCs like Maruti, HUL, and a couple of, some decent domestics like Hero Moto and Bajaj. But by and large, the India is either category A, right? 90% of our market, or the few celebrated Indian companies, category C, HDFC Bank, Asian Paints. The bulk of the country has polarized in this dimension. Category C, you get super governance, not because the regulator is enforcing it, but because it's in their self-interest to drive good governance. Category A, you're not going to get good governance neither for love nor for money.
Okay, no, that's very good, very comprehensive. So I think we'll stop it there, gentlemen, because I think I promised to keep this to 30-35 minutes. And of course, as you've pointed out, you are always welcome to have one-on-one calls, other follow-up sessions with investors and prospective investors, as you have been with us. And just want to re-highlight the strategy and your very disciplined, systematic approach to investing in Indian markets, which has been very successful. So thank you for your presentation today, and thank you everyone for attending. For any follow-up information, please can reach out to me and I can make it happen. Yeah, we'll be sending out a recap.
And, Eric, if any of your clients want to read our books, there's a monopolist called Jeff Bezos. He's made our books available free of charge on a platform called Kindle. Rakshit, you just want to show the names of the books. So if any of you are sort of going to the gym and you're lost for what to listen to in the gym, Unusual Billionaires is available in audible format, free of charge. Got to see the kindness of the people in Amazon. The other two books you have to pay for, unfortunately, but both the Kindle download is low cost for Unusual Billionaires and Coffee Cat Investing. And these are the highest selling books on investing written by local Indian authors. Until we arrived in India, people used to read American books on investing and somehow believe that that can allow them to make money in India.
Fantastic. Well, I was going to mention that. So thank you, Saurabh, for highlighting that. So there we go. Some additional insight into what the team's thinking and some interesting reads. So thank you very much, everyone. And we'll be in touch. So thanks a lot for joining in.
Thank you.
Thank you.
Thank you.